Good afternoon, everyone. Thank you for joining this webinar. Over the next 30 minutes, we plan to give some background on private mortgage insurance, the evolution of this industry, and elaborate on how we at DBRS Morningstar give credit to mortgage insurance in our rating analysis. Just as reference, we had published methodology to evaluate MI credit for non-agency securitizations earlier this year. At the end of this presentation, we will have some time for a Q&A session on this topic. So for today's webinar, we have Yash Shah, a senior analyst in the RMBS team, who, among other things, is a specialist in mortgage insurance, and me, Sagar Kongettira, a senior member of the RMBS team. All right, let's get started. As many of you probably know, mortgage insurance has been around for a very long time and is dominated by the FHA, VA, and private mortgage insurers. First off, Yash, can you briefly describe what exactly does mortgage insurance cover and some differences between the coverage and structure of FHA, VA, and private mortgage insurers?
First of all, good afternoon, everyone, and thank you for joining the webinar. Coming to your question, Sagar, first let me talk high level about what mortgage insurance is, and then I can go into further details. Mortgage insurance is an insurance policy that protects a mortgage lender or title holder if the borrower defaults on payments or is otherwise unable to meet the contractual obligations of the mortgage. It lowers the risk to the lender and makes borrower qualify for a loan that otherwise borrower might not be able to get. But it increases the cost of the loan as borrower is now required to pay mortgage insurance premium. On a borrower default, mortgage insurance generally covers defaulted balance, delinquent interest, and expenses like legal fees, property preservation costs, taxes, insurance, statutory costs of foreclosure, etc. But there are nuances between various forms of mortgage insurance. Talking about the FHA loans, these are mortgages insured by Federal Housing Administration, a subsidiary of the Department of HUD or Housing and Urban Development. It is there to make homeownership accessible for low to moderate income and first time home buyers. FHA insures credit risk on 100% of the loan amount. The premium payment has two components. The first one is an upfront fixed rate premium, and the other component is an annual premium that varies based on loan amount, LTV, and term of the mortgage. Moving on to the VA loans, these are mortgages guaranteed by Veterans Administration, a department of federal government. These are available for eligible veterans, active duty service members, and surviving spouse. In contrast to FHA, VA only insures 25% of the loan amount. While VA loans do not require premium payments, they require borrower to pay funding fee, which varies based on LTV. And now coming to private mortgage insurance or PMI, it is a private form of insurance. The GS is required by law to obtain credit enhancements for loans with LTV ratios above 80%, and mortgage insurance is one form of the credit enhancement. Unlike FHA and VA, PMI coverage is not a static percentage. It depends on the LTV of a loan. More riskier the loan gets, more coverage is required uh, in order to bring down the post MI LTV to below 80%. Additionally, a smaller share of PMI industry's business also include insuring loans held in lender portfolios and those securitized into private label securities.
Thanks, Yash. Now, focusing on private mortgage insurance, there are various types of mortgage insurance at both a loan and pool level, which are really structured to lower loss severities and thus reduce mortgage losses. Yash, can you briefly describe the differences in these types of insurance?
Sure, Sagar. Let me start with loan level MI. There are mainly two types of loan level MI: borrower paid MI or BPMI as it's called, and lender paid MI or LPMI. BPMI is by far the most common type of PMI. There are a couple of key differences between BPMI and LPMI policies. One, as the term suggests, for BPMI policy, borrower will be making the monthly mortgage insurance premium payments, while for an LPMI policy, lender will be making the premium payments. Second, and the most important distinction is that under the Homeowners Protection Act, BPMI policies taken out for single unit primary residences are eligible to be terminated or cancelled if certain conditions are met. BPMI will be automatically terminated when amortized balance is scheduled to reach 78% of the original property value and borrower is current on the mortgage payment at that time. Additionally, borrowers can also initiate termination of the policy based on the original or current property value of the homes, provided they meet certain LTV, seasoning, and payment history criteria. To qualify for cancellation, a current valuation in the form of a broker price opinion, value certification, or new appraisal is typically required. On the contrary, LPMI generally cannot be cancelled. Coming to pool level MI, the insurer provides insurance coverage on a pool of mortgage loans. The insurer reimburses for losses due to defaults on a pool of mortgages once losses exceed a deductible amount, and they will cover until a stop loss amount is reached.
Thanks, Yash. What may be also useful for the attendees is if you can walk through an example of potential insurance claim payouts for a high LTV loan that defaults in the future.
Let me take a step back before we take a look at an example. And I first let me mention various claim settlement options that an MI company has. There are typically three claim settlement options the insurer has: percentage option, pre approved sale option, and an acquisition option. In the percentage option, MI company pays the coverage percentage times the approved claim amount. In the pre approved sale option, MI company pays the minimum of realized losses after taking into account the net sales proceeds and the amount that would have been had been paid as calculated under the percentage option. While with the acquisition option, MI company buys property and takes the title from the insured by paying the approved claim amount and then manages the liquidation as an REO. I would like to note that percentage option and pre-approved sale option are the most commonly used settlement options. With this, let's take a look at an example of MI claim payout. Looking at this table on the right hand side of the screen, this is an example for a loan level MI policy with an MI coverage of 25%. Now, how to calculate how the total claim amount will get calculated is basically, as I had mentioned earlier, it includes the UPP of the loan, some delinquent interest, and expenses that are incurred for the for say property preservation, foreclosure, etc. So in this example, the defaulted loan balance is 370,000. The expenses were incurred to the tune of 4,500 and the delinquent interest is 14,500. So the total claim amount is 389,000, which is summation of those three components. Now, if the MI company selects the percentage option as one of the settlement option, then you can look at the row with the bullet point G, wherein it will directly pay the claim amount times the MI coverage. So in this case, it will be 389,000 times 25% MI coverage, which comes to 97,250. But if there was a pre-approved sale that was done and the net sale proceeds was 245,000, then they will try to calculate the realized loss after taking into account the net sale proceeds, which is in row with bullet point H. So the realized loss is basically the approved claim amount minus the net sale proceeds. In this case, it turns out to be 144,000. And now the MI claim payout will be minimum of 144,000 or 97,250, which was the percentage option, and in this case, it turns out to be 97,250.
Thank you, Yash, for that example. Now, moving on to the MI industry. During the last housing crisis, there were many failures, mortgage insurance being one of them. And since the crisis, the industry has made a concerted effort to implement significant reforms and enhancements, which should really provide more certainty on the payout of potential claims. Yash, can you first touch upon the evolving landscape of mortgage insurance since the crisis, and also maybe highlight the positive changes that you have seen taking place?
Certainly. As you rightly mentioned, Sagar, the mortgage industry, including mortgage insurance sector, has come a long way since the last financial crisis. Post crisis, there has been a lot of positive developments in the MI sector. Let me cover each of these points on this slide one at a time. During the crisis, as the borrower defaults increased, mortgage insurance industry came under a severe financial stress. The industry went through consolidation phase. Some of the MI firms even got squeezed out of business. There were 8 MI firms operating prior to the crisis. Three of them, namely PMI Mortgage Insurance Company, Republic Mortgage Insurance Company, and Triad Guarantee Inc., filed for bankruptcy and they entered into runoff mode. They ceased writing new insurance business and were restricted from paying out claims so that they could conserve capital. Later, a portion of the claims were paid in cash while the remaining were deferred to be paid at a later date. Currently, RMIC or Republic Mortgage Insurance Company is paying 100% of the claim amount. PMI Mortgage Insurance Company distributes 81% of the claim amount, while Triad pays 75% of the claim amount. Fast forward to today, there are six PMI firms who operate currently. It's Arch, Enact, or formerly known as Genworth, Essent, Radian, MGIC, and National MI, of which Arch, Essent, and National MI are new players that emerged after crisis. Arch acquired operations of three legacy MI firms as well. Moving to the underwriting practices, these have gone through significant changes. MI firms have incorporated a more robust underwriting process, strengthening in house underwriting capabilities, performing upfront quality control, reducing their reliance on delegated underwriting channel, and avoiding non traditional products. Performing upfront due diligence facilitates early detection and remediation of problematic loans and is a useful tool to assess the quality of the underwriting performed by the lenders. Coming to capitalization, the MI firms are regulated at the state level by the Department of Insurance in each state. State statutes require MI firms to maintain contingency reserves and reserves for expected losses and unearned premiums. Although the state statute require MI firms to maintain a specific risk to capital ratio, it does not take into account the credit quality of the insured mortgage. Following the crisis, the GSEs enhanced PMI regulation through the Private Mortgage Insurers Eligibility Requirements, or widely termed as PMIERs, that was finalized by FHFA. PMIERs prescribe detailed capital charges. They also take into account the riskiness of mortgage based on which is based on credit score, LTV ratio, origination year, loan type, and maturity, among other factors. Non-performing loans are subject to higher capital requirements. This resulted in substantial reduction in the risk to capital ratio and strengthened capital position of all the MI firms. Next, MI companies have adopted various risk management practices, like risk based pricing is one of them. Unlike traditional rate cards, risk based pricing provides a more granular approach to risk classification, price refinement, and flexibility to an MI company to adjust pricing for a riskier mortgage. They also are now using reinsurance and insurance linked notes to manage their risk. And finally, there has been material updates to the master policy since the crisis, especially with respect to transparency on the conditions under which claim could be rescinded and inclusion of rescission relief provisions which were largely missing from the pre-crisis policies. For example, under 2020 master policy, the insurer will not rescind coverage for material representation or underwriting defects if the insurer has completed independent review or an internal quality control, or if a borrower is current after 3 years with no more than two 30-day delinquencies and no 60-day delinquency. Improvements like this will, to certain extent, eliminate the risk of recession in future.
Thanks, Yash. Yes, a lot of healthy changes to the MI industry post crisis. Now, moving on to our analytical approach to give MI credit for a non agency securitization. So, our model has been set up to give loan level and pool level MI credit based upon mortgage insurance type, coverage percentage, etc. But there are two other important considerations in our analysis. First is the financial strength of the mortgage insurer, which may kind of put a cap on the MI credit. Yash, can you discuss how the financial strength rating of the mortgage insurer plays a role in our analysis?
Of course, insurers' ability to pay, especially in the times of economic and financial strain, is a critical part of our analysis when we consider giving credit to MI across various rating categories. Financial strength rating or FSR helps assess this risk. If the FSR of an insurer is equal to or higher than the rating scenario, DBRS Morningstar will generally give full credit to MI. In rating scenarios higher than the FSR of the insurer, DBRS Morningstar would limit the amount of MI credit to the dollar amount of MI credit given at the rating scenario equal to insurer's FSR. DBRS Morningstar is of the view that it takes time to transition into a more strenuous economic scenario, and the insurer is not expected to immediately enter such a stress state. The insurer is expected to continue to honor the appropriate claims until the economy reaches the level of stress that is beyond its ability to pay claims. Also, as mentioned earlier, MI companies' ability to pay was tested during the last financial crisis when certain mortgage insurers went into a runoff mode, but they continue to pay a portion of their claims and defer the remainder. Let us take a look at an example that will make things clear on how DBRS Morningstar would give MI credit at various rating categories, including rating categories above the FSR of the MI company. So in this table, this is an example for an MI company with a triple B FSR rating. This table shows starting with which is the row with bullet point A. Uh, these are basically for a pool of mortgage loans. These are the losses that are model calculated without giving any credit to mortgage insurance. In the next row, these are the losses that model calculates after giving full credit to MI. So in this case, the MI credit is not capped, not adjusted. This is simply put, you can say that this is assuming that the MI company is a AAA rated company entity. Now, So the difference between the losses is basically what is the MI credit that our model calculated at each rating category. So that is the row with bullet point C. So you can see that at single B, MI credit was calculated at 900,000, which is the reduction in losses with MI and without MI. At triple B, it is 2.3 million, and at triple A, it's roughly 4 million. Now, for a triple B rated MI entity, our model would cap the MI credit to the absolute level of MI credit that was given at the insurer's FSR rating category. So in this case, it gets capped at the triple B rating category MI credit absolute level. So that's the reason you can see in row D or row labeled D that all the rating categories above triple B, which is single A, double A, triple A, you will see that the MI credit is same as the triple B MI credit level. While at single B and double B, there is no adjustment to the MI credit. And that is how our model would calculate the MI credit, taking into account the financial strength rating of the MI company.
Thanks, Yash. Finally, can you also elaborate on a second important consideration analysis, the MI exception rate, which haircuts the MI credit? I think to get started on this discussion, it may be useful to just first talk about recessions, denials, and curtailments.
Sure, Sagar. Another important piece, as you rightly mentioned in our analysis, is MI exception rate at various rating categories. MI exception rate, simply put, is the percentage of total claims that insurer may not pay and or curtail. There are various reasons for which claims can be rescinded, denied, or curtailed. Insurer may rescind a claim, among other things, if mortgage does not conform to the underwriting guidelines. In cases of origination defects, for example, if the LTV was incorrectly calculated and it is now it has increased materially higher, which increases the risk as well. Or in cases of misrepresentation, like occupancy was misrepresented to be primary occupied, whereas it turned out to be an investment property. But I would like to again highlight what I had mentioned earlier. The new master policies have provisions for rescission relief when certain conditions are met. Insurer may also deny a claim payment if claim filing period has expired, or servicer fails to provide sufficient documents for MI company to review the claims, or there is physical damage to the property. Finally, insurer may curtail the claim amount if it includes amount that is not covered by the master policy. For example, attorney fee that has been claimed is beyond the allowable limits, or servicer did not follow the servicing guidelines. For example, there was delay in performing loss mitigation activity. All of the above factors would lead to reduction in the insurer's claim payment amount. In its analysis, DBRS Morningstar will adjust the MI coverage amount by an MI exception rate. We will consider the following factors to determine the base case MI exception rate. Starting with the historical data, we will review the historical rescission, denial, and curtailment data that will be provided by the insurer. Next is the master policy exclusions. DBRS Morningstar will review the master policy under which the loan or the pool has been insured. We'll review it for all the exclusion conditions and also for rescission relief provisions, and we would accordingly adjust the MI exception rate. Other factors that will go into our analysis will be like the originator and servicer quality after we perform the operational risk review on those entities, the representation and warranties framework that has been incorporated into securitization, the scope and results of the third party due diligence review, and some other unique items like portfolio or pool policy details on a case by case basis. After forming our view on the base case MI exception rate, DBRS Morningstar will apply multiples to base case exception rate to arrive at the exception rate for various higher rating categories. As you can see it on the table on left side of the screen, the multiples for different rating categories are listed in that table. In determining the multiples, DBRS Morningstar will generally start at the midpoint of the range for each of those rating category and then would adjust that multiple up or down based on certain factors like sufficiency of the historical decision, denial, and curtailment data that was provided by the insurer, industry position of the mortgage insurer, and finally the prevailing macroeconomic conditions.
Thanks, Yash, for walking through our analytical approach and also highlighting, all the changes we have seen in the MI industry. We are at the end of a presentation, and I think we do have a couple of questions. Also, just please note that a replay of the presentation will be emailed tomorrow. Yeah, the one question we got was, will we receive the slides after the webinar? Yeah, I believe this presentation, a replay of this presentation will be emailed tomorrow. Another question was, does the MI provider get to choose which claim settlement option to use?
Yeah, I would say it's totally based on the MI company. Uh, uh, they are the ones who will dictate which settlement option to choose. So I would say, yeah, the MI company is the one who will choose the claim settlement option. But as I mentioned, they are definitely not in the business to acquire properties. So that's the least used option. While the percentage option and the pre-approved sale, it all depends on the macroeconomic condition during the time of claim payment, and that those things will dictate which one of the option they will choose.
But another question is, are recessions from the crisis period considered in your analysis, especially since there have been many changes such as recession relief?
I would say definitely, as we have mentioned in this webinar or throughout this webinar, there have been substantial material positive changes from the pre-crisis policies to the post-crisis, or I would say specifically 2014 and 2020 master policy. That's the reason we will mostly focus on our analysis based on the decision, denial, and curtailment data related to the 2014 and 2020 master policies to come up with the base case MI exception rate. And for the multiples or to arrive at the higher rating category stresses, as it's already there on the slide that is being pulled up. The multiples are listed on the screen, and we will look at the three conditions that we mentioned, which is the sufficiency of data, industry position of the MI entity, and the macroeconomic condition to adjust those multiples to come up with the rating category, higher rating category exception rate.
All right. Well, thank you. I think those are the only questions we received. Uh, all right. This is the end of the webinar. Again, thanks again for all of you attending, and have a great rest of the day. Thanks again.